Here's the thing about having $20,000 in your savings account that nobody wants to tell you. It's not that the bank is happy you have it. It's not that they're giving you a medal or throwing you a party. In fact, if you're sitting on exactly that amount right now, you're probably doing something that makes your bank CEO genuinely uncomfortable. And I'm going to explain why in a way that might completely change how you think about money. As I spend way too much time thinking about why intelligent people make terrible financial decisions, if you're someone who's worked hard to save $20,000 and you're just letting it sit there, wondering if you're doing the right thing, I know most of you still won't do this, but hit subscribe and give this video a thumbs up, because what I'm about to show you is going to make you question everything you thought you knew about being financially responsible. So let me tell you a story. You've got 20 grand saved. You've been grinding for maybe 2, 3, 4 years to get here. You skipped the vacation, you drove the paid-off car longer than you wanted, you meal prepped when everyone else was eating out, and now you finally hit this milestone that's supposed to feel like security, right? Except it doesn't feel like enough. You open your banking app, you see that number, and instead of feeling wealthy, you feel stuck. Like you're doing something right, but also somehow doing it wrong at the exact same time. That feeling? That's not an accident. That's actually your brain recognizing something your bank is desperately hoping you won't figure out. Now look, I need you to understand something fundamental about how banks work, because this is where most people's understanding completely falls apart. When you deposit $20,000 into a savings account, you think you're being responsible. You think the bank is keeping your money safe, maybe paying you a little interest, and everyone's happy. But here's what's actually happening, and this is going to sound wild, but stay with me. The moment your $20,000 hits that account, the bank doesn't put it in a vault with your name on it. They immediately turn around and loan out approximately $18,000 of those dollars to someone else. Maybe it's a mortgage at 5%, maybe it's a car loan at 7%, maybe it's a credit card balance at 22%. And while they're making all this money off your money, what are they paying you? Right now, the average savings account interest rate in the United States is 0.46%, not 4.6, 0.46. Do the math with me. On $20,000, that's $92 per year. That's less than you spend on coffee in a month. Meanwhile, the bank is taking that same money and generating potentially $4,000 or more in interest income from the loans they're making with it. This is where it gets strange. The banking system is fundamentally built on the assumption that you won't understand this relationship. They're counting on you thinking that saving equals winning. They need you to believe that the smart move is to accumulate cash in low-interest accounts while they use your deposits as raw material for their profit engine. A study from the Federal Reserve in 2023 found that Americans collectively hold over $1 trillion in traditional savings accounts earning less than 1% interest. $1 trillion, while inflation over the past 3 years has averaged about 4% annually, which means, and here's the uncomfortable part, every single year that money sits there, it's losing 3% of its purchasing power. Your $20,000 can buy about $600 less stuff this year than it could last year, even though the number on your screen stayed the same. Now, you might be thinking, okay, but isn't it irresponsible to not have savings? Isn't $20,000 my emergency fund? Shouldn't I keep it somewhere safe? And look, I'm not saying don't have an emergency fund. I'm not saying go blow your money on nonsense. What I'm saying is that there's a massive difference between being financially cautious and being financially manipulated, and most people can't tell which side of that line they're on. Here's what most people don't realize. The concept of keeping large amounts of cash in a savings account as your primary wealth-building strategy is actually pretty new in human history. Your great-grandparents didn't do this. They bought land, they bought buildings, they invested in businesses, they bought government bonds that actually paid real returns. The whole keep everything in savings mentality really took off in the 1980s when banks deregulated and needed to attract deposits to fuel their lending operations. They sold it as safety, as a responsibility, as the smart thing to do. But let's talk about what safety actually means, because I think this is where behavioral economics gets really interesting. When you feel anxious about money, what you're usually feeling anxious about is unpredictability. You want to know that if something bad happens, you're covered. You want to know that you won't be embarrassed or desperate. You want to know you have options. That's legitimate. That's human. That makes complete sense. But here's the thing. That feeling of safety you get from seeing $20,000 in your checking account, it's partially an illusion. Because what you're not feeling is the invisible erosion happening every single day. You're not feeling the opportunity cost of what that money could be doing. You're not feeling the fact that in 10 years, if nothing changes, that $20,000 will have the purchasing power of maybe $14,000 in today's dollars. There was a study done by behavioral economists at Princeton in 2019, and they found something fascinating. They gave people two scenarios. In scenario one, you have $10,000 and it sits in an account and the number never changes. In scenario two, you have $10,000 and you invest it and it fluctuates. Sometimes it's $9,000, sometimes it's $11,000, but on average, it grows to $15,000 over 5 years. And here's the wild part. 67% of people said they'd feel more secure with scenario one, even though scenario two mathematically made them $5,000 richer. We're psychologically wired to prefer stability over growth, even when that preference makes us poorer. The bank knows this. The bank is counting on this. So why do banks actually fear people with $20,000 saved? Not because you have the money. They love that you have the money, as long as you keep it with them in a low-interest account. What they fear is what happens when you wake up, when you realize that you've crossed a threshold where you have enough to actually do something strategic, because $20,000 is right around the amount where the math starts working differently. Let me show you what I mean. If you have $2,000 saved, your options are limited. You've got an emergency fund. That's great. That's important to keep it liquid, keep it accessible. But $20,000? That's different. That's enough to split into multiple strategies. That's enough to start thinking like someone who understands that money is a tool, not a trophy. Here's a framework that most financially successful people understand, but nobody really teaches. It's called strategic allocation, and it's based on a simple principle. Different dollars have different jobs. Not all of your money should be doing the same thing. Imagine your $20,000 in 3 buckets. Bucket 1 is your emergency fund. This is 3 to 6 months of expenses. For most people, that's somewhere between $5,000 and $10,000. This money stays liquid. High-yield savings account? Sure, but at least put it somewhere that's paying you 2 or 3%, not 0.46. As of right now, there are online banks offering around 4 to 4.5% on savings. Same FDIC insurance, same safety, just less physical branches, which you probably never go to anyway. Bucket 2 is your opportunity fund. This is maybe $5,000 that's accessible but working harder. Maybe it's in a short-term bond fund. Maybe it's in a money market account. Maybe it's in treasury bills that are currently paying around 5%. The point is, it's still relatively safe, still relatively accessible, but it's earning something real. Bucket 3 is your growth fund. This is the remaining $5,000 to $10,000 that you're investing for the long term. Index funds, retirement accounts, diversified investments. This is the money that's going to compound over time and actually build wealth. Now, look, I can already hear the objections. What if I need all $20,000 for an emergency? What if the market crashes? What if I'm not good at investing? Let's address these one by one because this is important. First, if you need all $20,000 for an emergency, you're not having an emergency, you're having a catastrophe. And in that scenario, you're probably accessing credit anyway, or selling assets, or doing something beyond just pulling cash. The vast majority of emergencies are in the $2,000 to $5,000 range. Car breaks down, medical expense, temporary job loss. That's what bucket 1 is for. Second, yes, markets fluctuate, but here's the thing about market crashes that nobody seems to remember. They recover. Every single one has recovered. If you have a 20-year timeline, which you do if you're building wealth, the fluctuations don't matter. What matters is time in the market, not timing the market. There's data from Vanguard showing that between 1926 and 2022, the stock market had positive returns in 74% of all calendar years. That means if you pick a random year, you have a 3 in 4 chance of making money. Over 10 years, 94% positive. Over 20 years, 100% positive. Third, you don't need to be good at investing. You need to be good at not panicking. There's a reason why the default advice is low-cost index funds. They're boring. They're diversified. They require zero skill. You're literally just buying a tiny piece of the entire economy and letting capitalism do its thing. But here's what's really happening when you keep all $20,000 in a savings account. You're making a bet. You're betting that doing nothing is safer than doing something. You're betting that the visible number staying the same is more important than invisible growth. You're betting that your anxiety about market fluctuations is more rational than your anxiety about falling behind financially. And the banks are thrilled that you're making that bet because they get to take the other side. They get to use your capital to generate returns while paying you almost nothing. It's the most one-sided trade in finance, and it's completely legal because you're doing it voluntarily. There's a concept in economics called opportunity cost, and it's one of those things that sounds boring but is actually life-changing when you understand it. Opportunity cost is what you give up by making one choice instead of another. And the opportunity cost of keeping $20,000 in a 0.5% savings account for 10 years, assuming you don't add anything else, becomes $20,122. Congratulations, you can buy half a nice dinner with your gains. $20,000 invested in a diversified index fund averaging 8% annual returns, which is below the historical average, becomes $43,178 in 10 years. That's $23,000 in growth just appearing because you let compound interest do its thing.
The difference between those two scenarios is $43,000 versus $20,000. That's a $23,000 opportunity cost for the feeling of safety. Now, here's where the psychology gets really deep. A lot of people know this math. They've seen the charts, they've heard the advice, but they still don't act. Why? Because there's something emotionally satisfying about having a big number in your checking account. It feels like an accomplishment. It feels like you're winning at something. And the thought of that number going down, even temporarily, even strategically, triggers loss aversion. Loss aversion is this well-documented psychological phenomenon where people feel the pain of losing money about twice as intensely as they feel the pleasure of gaining money, which means that the fear of your $20,000 becoming $19,000, even for a month, feels worse than the excitement of it becoming $25,000. Banks don't advertise this, but they absolutely understand it. Their entire marketing strategy is built around making you feel smart and safe for keeping money with them. They'll send you congratulations when you hit savings milestones. They'll show you charts of your balance growing. They'll use words like security and peace of mind and FDIC insured, all of which are technically true, but strategically incomplete. What they won't tell you is that inflation is a guaranteed loss, and market fluctuations are a possible loss, and you're choosing the guaranteed loss because it feels safer. Here's what I want you to do if you're sitting on $20,000 right now. I want you to get honest about what you're actually afraid of, not what you think you should be afraid of, not what someone told you to be afraid of. What actually keeps you up at night? If it's not having enough cash for an emergency, cool. Keep 6 months of expenses liquid, but be honest about what 6 months of expenses actually is. If your rent is $1,500 and your other expenses are $1,000, that's $15,000 a year, which means 6 months is $7,500, not $20,000. If you're afraid of the stock market, I need you to understand that your fear is based on stories, not statistics. Yes, markets crash. They also recover. And the people who lose money are the ones who panic and sell at the bottom, not the ones who stay invested and wait. If you're afraid you don't know enough, that's fair. But the beautiful thing about index investing is that it requires you to know almost nothing. You're not picking stocks, you're not timing anything, you're literally just buying the entire market and waiting. There are target date retirement funds that do everything for you automatically, based on when you plan to retire. You could set it up in 15 minutes and never think about it again. Here's the action plan, and I want you to actually do this, not just nod along and forget about it. Step 1, open a high-yield savings account if you don't have one already. Move your emergency fund there. This is the easiest possible step, and it immediately makes you 2 to 4% more per year. Step 2, max out any employer retirement match you have access to. If your job offers a 401k match, that's free money. If they match up to 5% and you're not contributing at least 5%, you're leaving thousands of dollars on the table every year. Step 3, open a Roth IRA or a traditional IRA and start contributing. For 2024, you can put in up to $7,000 per year if you're under 50. That money grows tax-free or tax-deferred depending on which type you choose. This is one of the most powerful wealth-building tools available to regular people. Step 4, if you've done all of that and you still have money left over, open a taxable brokerage account and invest in low-cost index funds. Set up automatic contributions so you don't have to think about it. 10% of your paycheck, 5%, whatever you can do consistently. The goal isn't to be perfect. The goal is to stop letting your money be weaponized against you by institutions that profit from your inaction. I know this is uncomfortable. I know it feels safer to just leave everything alone and not think about it. But here's the thing about financial security. It's not a feeling, it's a math problem. And the math is screaming at you to wake up. Your $20,000 is a tool, not a trophy. It's potential energy, not kinetic energy. And every day you leave it sitting in a low-interest account, you're letting someone else capture the value that should be yours. The banks don't fear people who save money. They fear people who understand money. They fear people who ask questions. They fear people who realize that the system is designed to keep them comfortable but poor, secure but stuck, responsible but broke. You've done the hard part. You've built the discipline. You've delayed gratification. You've created the foundation. Now it's time to build the house. Don't let anyone, including your own fear, convince you that the foundation is the finish line. If this video changed how you think about your savings, do me a favor. I know you won't do this, but still, share it with someone who needs to hear it. Someone who's working hard and saving diligently, but hasn't figured out the next step. Someone who deserves to know that being smart with money means more than just watching a number sit still while the world moves around it. You've got this. You're closer than you think. And $20,000 isn't just a safety net, it's a launching pad. Time to use it like one.